If you're someone who has tapped as much as you possibly can on your line of credit and you have a large percentage outstanding, if there's a pullback in the market or the value of your portfolio changes dramatically, the custodian might demand immediate payment of any portion of the loan outstanding.
Welcome back to another episode of Off the Wall. Markets never slow down. We don't either. And we're here to kind of help everyone stay one step ahead. So I'm Nate Tonsager, as always, joined by my co-host, Dave Armstrong. Dave.
Nice to see you live in the global headquarters of Monument Wealth Management.
Yeah, new studio.
Everybody. You'll notice the Pink Floyd Wall album behind me. Get it?
Dave's really excited about this.
Yes, I know I am. So you'll have to leave a note in the comments and tell us if you are pro or con us changing the shelving items. We have a little debate offline about that. I think that'd be kind of fun. But anyway, that's not what we're here to talk about. What are we here to talk about today?
Today we have a special guest with us for the topic. So we brought in Emily Harper, who is a host of Between Sips, and brought her in for a key conversation that we're having with a lot of, I think, investors. A lot of people are talking about is, how do I borrow or portfolio lending solutions? So there's a lot of kind of ways that you can look to borrow from your portfolio. We thought it'd be a good idea to break down why people are doing this, how can you do it, and maybe most importantly, what factors do you need to be thinking about before doing it? So, Emily, we'll kick it right off with you. What are some ways that you're seeing smart investors, smart people use their portfolio when it comes to borrowing funds?
Yeah, so if you have listened to old episodes of Off the Wall, or if you've been listening to Between Sips, you might know that I'm a big tax person. I love talking about tax. I talk about it a lot with our clients. And I think tax is one really big component of why people might borrow from their portfolio. Borrowing from your portfolio when you maybe need cash or you want to be able to benefit from the value of your portfolio, maybe without selling positions. You can do that without actually realizing gains when you use some of these solutions that exist for taking a loan from your portfolio. And we'll talk more about those specific types of borrowing opportunities that exist. But I think tax is a big piece of it, and really being able to tap into your portfolio, leverage the value of your portfolio without having to realize capital gains and paying taxes is a huge considering factor. I've had cases where someone will say, I really want to buy this piece of property. It's a really great opportunity. It's a hot market. I need to be able to move fast, but they don't have the cash on hand to immediately do it. They've used things like lines of credit tied to their portfolio to free up some cash without having to sell anything, not realizing taxes, not disrupting their portfolio allocation, or really messing with their investments. So it's a really good opportunity if there's some kind of temporary need for cash. This is a little more timely maybe, but if you rewind back to 2025, the government shutdown was a pretty big deal at that time and was really impacting not only federal employees who get paid by the federal government, but a lot of businesses, a lot of government contracting businesses. So we had some clients who, their business is government contracting and they weren't getting paid, but they still had to pay their people and their expenses. So borrowing from the portfolio, as much as you want to try to keep personal and business separate, that's not always possible. So these borrowing opportunities can be really great for when the unexpected happens and really helping you maintain flexibility and optionality to pursue whatever means of getting cash is going to be the most effective and efficient for you in a given moment.
Yeah, and just a quick anecdotal story. I know we're going to get into the nuts and the bolts and the hows and margin versus line of credit, and we're going to talk about all those things. But I think that people probably inappropriately these days associate margin with danger. And I am an actual use case scenario to talk about because I recently opened up a line of credit on my own taxable portfolio here at Monument Wealth Management, because I'm also a client. But I felt like for just a couple pieces of paperwork, I now have an open line that I can just draw on for these short-term emergencies. It sits at a zero balance. I don't pay anything on it. But if I ever needed something, boom, it's there. And I don't have to, conversely, if I was going to say renovate a bathroom in my house and I said, I need $50,000 to do that. If I sold $50,000 of stock, I'm going to have to pay all the capital gains, especially after the past 3 years. But now I just borrow the money and then maybe I pay it back, or I don't know, maybe I don't because the portfolio keeps growing. I just keep carrying that balance at whatever the interest rate is, and probably better than paying taxes on it. Anyway,
well, and I
just
think
a quick anecdotal story about it's a testimonial, but not really.
Well, I think it's important too. The flexibility of it is sometimes you don't want to have to sell from your portfolio.
Mm-hmm.
You never want to be a forced seller. When the unexpected happens, if you need cash, if the markets aren't cooperating, this is another solution. Maybe the markets are down 10, 20%, and you want to tap into some of the lending that you can do just to give you that flexibility. And I think that's kind of a great way to kind of talk about the different ways you can do it. I think there's probably 2 major ones that we could look at and kind of talk about. Dave, I think you said you used one coming up here. So, and I guess I'm a golden retriever. I don't know if anyone can see we have actually a golden retriever.
You can't see Lila on the ground here. We're so sorry. But we'll post some pictures on social for you all to see Lila just basically napping down here underneath our feet. So,
but the big thing is again, a lot of people, these solutions can get complex, and we want to help make it easy for clients to understand and other people what this really means. So pretend I'm the golden retriever here and explain to me just in your kind of quick, what is margin? And margin is really, I think, the first solution we can talk about. So really, when you look at kind of what is the simplest version of margin, I think, Dave, you said it perfectly. It's very easy to set up.
right.
That's a huge benefit of it.
Mm-hmm.
You can turn on margin on taxable accounts. Usually IRAs, you can't do it. But with taxable accounts, you can turn on this capability that allows you to borrow normally up to 50% of the value.
Right. So since you're explaining it, pretend I'm the golden retriever. Okay. And explain it to me.
So as someone who used it, right?
Right.
That's
This is a test.
Yeah, right. You look at your portfolio value, your taxable value,
Uh-huh.
you sign some paperwork,
Mm-hmm.
and what that allows you to do is to take money from the portfolio without having to sell. You're basically taking out a loan against your portfolio.
Right.
And that's almost really as simple as it is. I think when people talk about it, the biggest maybe difference between margin and other lines of credits, you're not limited on what you could use the funds for. So when you take the money out of the portfolio, you can use it for a bridge loan to pay either employees to have the cash flow. There's some people out there, and I think this is where margin gets its risky kind of connotation, who use it to then buy more stocks.
Right.
And that's where a lot of the risk comes in. If you're using it more as a cash planning tool, I think the risks are very different.
Right.
So I guess, how did I do?
Well, that's great, because some of the terminology that listeners may recognize is you may hear on CNBC or something where people say like, oh, we're 130% long. Okay. Well, how do you get that extra 30% over 100%? You borrow money and then, like you said, invest it back in the portfolio. So if there's a downturn in the portfolio, the person who lent you the money is going to say, you got to sell some stocks to cover this loan because the portfolio balances. That's where things get so risky.
Yeah.
But if you're just borrowing the money to do something, here's a popular one I've seen in the past where people have said, I'm buying a new house and I haven't sold my old house yet. I need money for a down payment now. When I sell the house, I'll put the money back in. That awesome use of margin or line of credit, either one.
And I think with margin specifically, it is the ease of access.
Mm-hmm.
You can basically, once you have it all set up, you finish the paperwork, you can get those funds same day if you wire them out of your accounts. So there's not, a big process of really getting access to this. I think it kind of depends though, of course, all accounts are not able to add this. Usually retirement accounts, you can't do it. And not every position is what they call marginable, or you can borrow against it.
Mm-hmm.
So you're going to have to kind of do the math, do the legwork up front to see how much you can actually borrow. Again, normally it's around 50%. But I think, Dave, you're kind of hitting on one of the biggest maybe costs of a margin loan. And I think we just talked a lot about how easy it is, some of the benefits of it. Well, nothing in this world is free.
Right.
So when you look at the cost, in addition to the interest rate, which I want to talk about a little bit too, the biggest risk is having what they say is a margin call. So remember, your investments are the collateral on this loan,
Mm-hmm.
but your investments are moving with the market value. If that market value falls enough and all of a sudden your collateral is not large enough to cover your loan, you got 2 options and they have to happen pretty quickly. You can either put more money into your account,
Make a deposit.
which again, the whole point of this was you didn't have the cash, so you used the cash.
Mm-hmm.
or you're going to have to be forced to sell securities. So sell from your account, sell some of your holdings to pay down this margin loan. Well, I just said your account value has gone down. Now you're selling when things have already lost in price. You're locking in those losses just because you have that extra risk of the collateral if you borrow too much maybe against on that margin loan.
Right.
You can't carry it. And so I think that's always one risk that people really underappreciate, and that's more of a hidden cost than a direct one for me.
Highlight, though, that not every account is eligible, right?
Exactly. Yep. Like what I was saying is it really has to be a taxable portfolio. Because these are margin loans, they do not usually allow you to have a margin capabilities on an IRA account. And there's a variety of reasons for that. I don't think we need to really dive into the details there. It's more important that people, when you're thinking about, is this a solution for me? You got to remember, you got to have a taxable account to do it. You can't really do it on your 401k. There's different borrowing solutions there somewhat.
Right.
But those are even more complex and very specific to each plan. But if you have a taxable portfolio and you need that bridge funding, margin can be a solution. I think the other big cost you always have to think about, though, is in addition to it just being on taxable accounts, you're going to accrue interest on this. Now, you may not necessarily have to pay it in any certain timely fashion. You can accrue interest on it, but then interest compounds just like growth. So you want to have, that in your mind, but those rates can be pretty high sometimes on margin, if I'm being honest. With interest rates moving up over the past couple of years, you see margin rates, which are variable. So it's not a fixed loan. Again, there's no set payment terms, no set rate. They usually start at a base rate of 10% and then get added on the different spread. And 10% is really just numbers we're seeing across the industry. Everyone is different. So you can rate shop a little bit to figure it out. But, I've seen rates up to 12% to be borrowing, which is nothing to laugh at.
No, it's a credit card zone.
With a 10% cap that some people have been thinking about it too, right? You're above it.
Let's see what happens.
But I think that's something you got to be aware of is if you take a loan, it's not free. It never is. So margin does have a lot of benefits, but of course, cost with it as well.
Yeah. And Dave, you had brought up a good point about, when you take a loan from the portfolio, maybe you don't even have to make payments because your portfolio is generating enough to cover that interest. But I think when you get to margin rates of 10, 12%, that's very difficult to do because not many portfolios are generating that kind of, interest or dividend income to cover that interest expense on a regular basis.
Right.
So,
and I think the way I've seen people use it is if a margin loan has a high interest rate associated with it, sometimes you just look at that and you say, that's just the cost of doing business. I need the money.
Yeah.
So I'm going to borrow it and then I'll pay it back later. And some people, if they get a better margin rate or interest go down, you can look at it and say, well, this is actually, a positive rate of return for me because my portfolio has been earning just like S&P 9 and change percent a year. And my cost of carry is 5%. People may choose to just let it ride, because the taxes factor into it. But you're absolutely right. That's a risky thing. You don't want the interest compounding faster than the growth in the portfolio. Obviously, you don't need Monument to tell you that.
No, you don't want to be swimming uphill.
You should hire us anyway. But I'm just saying, right?
well, and there's such a thing as an exception rate potentially too with margin, where a good advisor might be able to get you an exception rate on margin depending on the relationship that they have with the custodian that holds the money. But generally, those rates are still fairly high.
Right. Yeah. I think about it like this, and this goes to it's common in our industry to have clients who say, like, I've got multiple relationships. One of the benefits to consolidating relationships is that you're getting pallet pricing, right? You're going to get a better deal if you've got a lot of your stuff on a pallet. You're going to get better pricing. So there are advantages to making sure that if you're looking to borrow money, find the place that has the most amount of your assets and go to them first, because they probably have much more pricing power than, say, a smaller investment manager that you've hired or something like that, and don't have a lot of scale there, so you probably won't get great rates there.
Yeah.
But
well, that's kind of a great segue too, because there's margin isn't the only option.
Right. Let's talk about that, because I kind of polluted the waters earlier by saying line of credit. So, let's make sure that we are defining those two things, because they have a difference.
They do. And I think, when you look at it, we just talked a lot about margin. The other solution that I think is becoming really popular like way more popular than when I started in the business years ago. I didn't hear about it often, but it's called a pledged asset line of credit.
Mm-hmm.
So I think shorthand, people call them pals. And yes, it's kind of the joke of they could be your friend, but not every friend is a pal, maybe is a way to say it. It's a lot, I think, like what people are familiar with a HELOC. So I'll kind of pause there again, just like we did the golden retriever explanation of margin. All right, Emily, your turn now.
Oh boy.
If you can kind of just give us the breakdown of what is a pledged asset line of credit?
Yeah.
How does it kind of operate?
Yeah. So a pledged asset line of credit is something that, similar to margin, is going to be tied to your investment portfolio. So it is a way to get some liquidity or cash from your portfolio without having to sell any positions to do that. Again, similar to margin, only non-retirement accounts are eligible for lines of credit. But typically you'll see these offered where maybe a custodian also has a bank as part of their offering or their relationship, where they can offer these kinds of lending products. Very similar to margin, you don't have to have a specific purpose in mind for using the line of credit or even setting it up. So what we've actually seen a lot of is, people will set these lines of credit up just because they can. They don't necessarily immediately plan on drawing on it, but it gives them a sense of security that they have some way to quickly access funds if they need to, without having to have piles of cash sitting on the sidelines. One thing that I think is really interesting with the pledged asset lines of credit is they may actually have higher borrowing limits than margin. So you mentioned 50% was the borrowing limit for margin, but depending on what you actually have inside of the investment portfolio, some types of investments may be eligible to be borrowed against at a higher rate than 50%. Not that you should, not that you should leverage your portfolio by 80%, but you may have a higher borrowing limit than 50% of whatever is in your non-retirement portfolio. So that can be really beneficial if you need a really large sum of cash for whatever reason for a temporary purpose. If you do set up a line of credit and you tap into that to get some cash for whatever reason, you just make regular interest payments. You can make principal payments at any time. So again, it's very flexible. Or not. And there's no set term for these loans. So if you think about a traditional line of credit that you might get at your bank, there might be a 10-year term on that or some other term that dictates how much your payments are going to be. But in this case, you really just have those interest payments that you're making regularly, and then you can or may not choose to make principal payments, but they have to be made at some point.
Right. Oh, yeah. Right. Delaying the inevitable.
Yeah. Now, here's where I think lines of credit, in addition to just the tremendous amount of flexibility they offer, from an interest rate standpoint, they may be less expensive than a margin loan. So typically with these lines of credit, at least in our case with our custodian that we use, there's some baseline market rate of interest that is assessed. And in our case, help me with the naming, guys. I think it's secured overnight
Finance rate.
Finance rate. Thank you. SOFR.
The old LIBOR.
It used to be LIBOR, and I knew what LIBOR was. But there's that market base rate. And then usually there's some spread. The bank has to make money. They're not in the business of lending money for free. So there's that base rate, there's the spread. But what's really interesting is the spread that you're charged is really going to depend on the value of the assets that you're pledging as collateral. Meaning, say your portfolio is, $5 million and you're willing to pledge, all of that or a large amount of that. Maybe there's a break point at that threshold where you're getting a lower spread. Typically, the more collateral that you have to lend against, the lower your spread is going to be. And there might also be additional discounts depending on the size of your relationship with that custodian. So even beyond what you're pledging as collateral to secure the loan, the custodian might look at the entirety of your relationship, not just with any one advisor either. They might look at how much money do you have here total across all of your relationships, and offer a further discount. They're really in the business of wanting to be competitive with these lines of credit. And in our experience, we've seen very, very competitive rates.
Yeah.
And I think, like you were saying, you're pledging all this as collateral. That doesn't mean you're taking out a loan for that amount.
Right.
So in order to get the discount, just have a bigger line of credit.
Right.
You don't pay anything if you don't tap into it. And I think the other thing that always jumps out to me is margin. You just had to sign some paperwork to get it added to your account. Now, there is a little bit, I think, a more complexity maybe with a PAL account or pledged asset line of credit.
It's actually not as complex as you might think it is. In most cases, it's a very easy digital process that doesn't even require you to sign off on a form, like a hard form. Like, you can go through your online portal and your advisor can help you with this end to end to set up the line. And usually it's almost same day as far as approval goes. So if you've ever taken a home equity line of credit, because you mentioned that, you might be thinking, I had to go through this appraisal process and it took weeks and weeks and weeks of back and forth with the underwriting team to get this secured. And then there were closing costs and I had to have a notary come to my house. None of this really exists with the pledged asset line of credit, because you're pledging a portfolio of publicly traded investments. The value of that is known and is known on a daily basis. It's not like your house where that has to be appraised. It's a very quick process, very easy, not a lot of lift.
There's also no credit check, right?
Yeah. I think it's a soft credit check.
I think it's soft.
Yeah, like kind of when you go to Credit Karma, right? They do a soft check there. So again, I guess I was saying it is a hard process. It doesn't really seem like it.
Yeah. And at least in our case with the lines that we've set up for people, there's no cost to set it up, no cost to close, no cost to maintain it. So again, if you're someone who's looking for flexibility in your life, or you just need that optionality to be able to have access to cash for whatever reason when you need it with very minimal impact, setting up a line of credit is a good practice to consider if you find yourself having those kinds of needs.
Yeah, I did it. It was so fast. And then I got a little bit of mail and I get a statement, just like you get a statement on any other account, shows zero balance. And it was super easy. And now if I need cash, I just call Cecilia and say, I need you to wire this money out. And that's it. I don't have to sell anything or do anything. I love it. I think it's great. It gives me some peace of mind.
It's a safety net, right?
Yeah,
I think
right.
You hear a lot of, sometimes you feel like you might be walking a tightrope. Well, sure, if you're a business owner or kind of really anyone who's had costs rise over the past couple of years, sometimes you're on that tightrope. This is the safety net.
Yeah.
Again, it's the benefits we just talked about. So, again, as I said, nothing comes for free. So when you're thinking about a pledged asset line, kind of what are the costs maybe that a lot of people aren't talking about?
Yeah. So beyond just the interest that you'll be paying, there is a similar risk as margin here, where you're pledging assets as collateral, and those assets are going to change in value, and there could be some systemic market factors that cause your portfolio to really decline in value. So if you're someone who has tapped as much as you possibly can on your line of credit and you have a large percentage outstanding, if there's a pullback in the market or the value of your portfolio changes dramatically, the custodian might demand immediate payment of any portion of the loan outstanding, or they could request the full amount of the loan outstanding. It's not a set formula necessarily like it is with margin, or they may just require additional cash or securities to be added to the account to prevent that loan from being called. So you do have to be careful with how much you are leveraging the portfolio, and you want to be reasonable in what you're drawing on the line. There might also be some further restrictions that you have on your accounts. We've seen it can be difficult to move money out of accounts that don't already have standing instructions once you set up a line of credit. So you want to be proactive about making sure Any bank accounts that you might want to transfer cash to are already set up to receive that cash, because you might be restricted on withdrawals from the account, or setting up new places to send those withdrawals. You might be limited on things like checking or debit card features that are tied to those accounts, or bill pays. And there might be some restrictions around what you can invest in that account. I know options trading is something that becomes a little bit more difficult when you have a line of credit on an account.
Yeah, I think that's an important thing to consider is you are restricted in some ways. That safety net isn't going to be free, even if you're not using it. But it doesn't mean you're permanently restricted. I know we've worked with a bunch of people that are working on paying down the PAL balances that they've drawn and doing that from their portfolio growth.
Yeah.
So kind of what you were saying, Dave, it's not like it's impossible to get money out of this account. You just might have to sign some paperwork and tell the bank who is, underwrote this loan, this line of credit, hey, money's leaving the account. And they just need to factor that in. So again, you're not permanently locking your account down forever. You can still sell from it. You still can trade in it. You just might be restricted from doing maybe a little bit more exotic things with your portfolio, which isn't a bad thing. In some cases, if you need the cash, the safety net is much more important than being able to lever your portfolio or write call options and do all this other stuff that maybe wouldn't give you as much benefit.
Right.
All right. Well, I think we just covered two brilliant ideas, right? We just completely solved everything.
I can tell it's going to be a very popular episode by how asleep Lila is down there. So I hope that's not an indication of how popular this topic is with listeners.
No, and I think, again, it's an important one that we're hearing more about because a lot of people want to have optionality, flexibility.
Right.
And this is all that is. So, all right, we have these great ideas. Now, before I go and actually start tapping into them, so I've already set up one of these options. What do I need to be aware of? I think is a really important topic because, again, there are costs that we talked about. We've covered a lot of them, but I guess if a client was coming to you and say, hey, I want to start drawing on my PAL account, my line of credit, or my margin, what are kind of the things that they should have in the back of their minds or be remembering?
Yeah, I would say just have a game plan for how you want to make your interest payments, whether that's you are confident that your portfolio is generating enough in interest and dividends to pay that, or you're going to set up a monthly transfer from your bank to cover the interest payments. But I don't think you want to set up or draw on some kind of line of credit or margin and not have a plan in place for covering interest, or just assume that your portfolio is going to cover it. And then I think ultimately a plan to pay it off. I know, Dave, you've said maybe you're not going to pay it off, but maybe that plan is, hey, I'm going to sell from my portfolio to cover this off because it's done so well. Or maybe it's just a temporary need and you know that money is coming down the road from either selling something else or some bonus that you might be getting or some source of income where you'll have cash to pay off the principal amount outstanding.
Yeah, it is debt, right? At the end of the day, it's debt. And when you think about it, I think you hit the two key points of whenever you take out any debt, you don't want to make it compound like we were talking about. You don't want that interest to continually earn more interest that you have to pay on. And just watch this balance of your debt grow unchecked and uncontrolled. So again, it's having a plan. And that's where we've seen a lot of success with people. And to Dave's point, some people carry a balance and they say, okay, when my portfolio hits value X, I'm going to start selling from my portfolio to start paying down this. But really, again, because compounding works both ways, you still have to figure out, how do I keep the overall balance in check? It's just planning. I wish it was more complex and being like, hey, there's this great factor. It's really just planning and planning around cash.
You said it before. It's about providing the optionality, right? So I'll just make up a hypothetical situation. Somebody is a high income earner and gets a big bonus at the end of the year, but they want to renovate a bathroom in March. So they could borrow the money, and then when the loan comes or the bonus comes in at the end of the year, they can pay it off. It's just about having those options. Whereas without this, you'd say like, well, we can't do the kitchen until next year after I get the bonus. So it's really nice to be able to have that flexibility. And it's also, for me personally, my balance is zero, by the way, just so you know. But if there's an emergency, if something catastrophic happened and I need access, it's minutes before that money, hours.
Yeah.
Before that money gets wired into my account, it's instant access. I don't have to set anything up, and it's all just sitting there for free. Not cost me anything to have that open line.
Yeah, and you don't have to sell from your portfolio.
Right.
And if you want to, even if you have these options, you can still sell from your portfolio, pay the taxes, and just pay for it.
but you don't want to have to choose that as
Right.
your only option.
Right.
And that's where like using your portfolio intentionally, strategically, doesn't just mean trading it and watching it grow. It means kind of planning for your whole life and letting it support everything for you. So
Right.
it seems like a no-brainer. Again, I think we solved it. It's a brilliant idea if we use correctly. So,
Right. Yeah.
but again, you got to think about those two factors. So,
Right. Well, if you've made it to the end of this episode, thank you so much for listening. We are all about optionality here at Monument Wealth Management. So this is one of the things we like to talk about is providing people with options and solving complex problems. In addition to that, Nate and I do a monthly episode called Ask Monument Anything, or AMA, and you can submit questions to us to answer on our AMA episodes. There's a couple different ways you can do it. You can leave comments in the YouTube videos. You can leave comments on social media. You can also just send us an email. I mean, that's pretty easy, right? So that email address is offthewall@monumentwm.com. So all one word, offthewall@monumentwm.com. We'll get the email and throw it on our next AMA episode and we'll answer. We had some interesting ones last week. I got all on a tangent about Navy cruisers, but you just never know what you're going to get here, right? Right, Lila? Yeah, okay.
exactly. So, and thank you, Emily, for joining us.
Yeah, thank you for having me. I've missed Off the Wall since starting Between Sips with Jessica. So
That's been fun.
nice to be back here with you. But in between sips, Jessica and I really have great coffee table conversations and talk about the topics that we're hearing a lot from clients that are really important to them when it comes to turning wealth into options. So be sure to subscribe to Between Sips as well.
Yeah, and a heads up, they don't let me on that episode. So you don't have to worry about me getting off on a tangent or anything. So
Different bias.
Right. But subscribe to both. They'll be right in my feed, and you never have to try and find new episodes. They're coming out all the time. So, well,
Right.
Thanks, Nate.
Great.
Thanks, Dave.
Thanks for setting it up. Great to see you guys.
The content presented by Monument Capital Management LLC is intended for general informational and educational purposes only. No portion of this content should be construed as the receipt of or a substitute for personalized investment, financial, legal, or tax advice. Monument is neither a law firm nor an accounting firm, and no content should be interpreted as legal or accounting advice. Any discussions of investment strategies, financial planning concepts, or related topics are general in nature and may not be appropriate for every individual or situation. Different types of investments involve varying degrees of risk, and there can be no assurance that any investment strategy, planning approach, or discussion referenced will be profitable, suitable, or successful for any particular person or circumstance. Past performance is not indicative of future results. From time to time, this content may reference hypothetical situations, illustrative examples, or stories that do not involve actual Monument clients. These scenarios are designed solely to illustrate concepts or demonstrate how Monument might approach similar situations and should not be interpreted as endorsements, testimonials, or guarantees of any particular outcome. No two clients, situations, or experiences are exactly alike, and results will vary. Nothing discussed should be interpreted as a guarantee that any client or prospective client will experience a specific level of results or satisfaction if Monument is engaged or continues to be engaged to provide investment advisory services. Monument's investment advisor registration status or any prior experience should not be construed as an assurance of future performance or success. Copies of Monument's current Form ADV Part 2A, Disclosure Brochure, and Form CRS, which discuss our advisory services and fees, are available upon request or at www.monumentwealthmanagement.com/disclosures.